Good afternoon. Welcome to the webinar co-hosted by LISC and OFN. We're doing a webinar on new research on the outcomes of CDFIs and the CDFI fund. Thanks for joining us this afternoon. Before we get started, I want to mention a couple housekeeping notes. First, we're recording the webinar to share on CDFI Connect afterwards. It may take a little time, but we'll get the webinar posted, the recording posted shortly after. Second, we encourage you to use the chat to introduce yourself, to engage and connect with other attendees. And third, you may use the Q&A box in Zoom to submit questions. We're going to have at least 10 minutes or so of audience Q&A at the end of the webinar, so please submit your questions during the course of the webinar in the Q&A period. Next slide.
Hello, everyone. So our agenda for today, I'll do some introductions in a second. We'll hear some research about the impact of financial assistance awards from Adrian. I'll then present some research from LISC on the impacts of CDFI lending on the wealth and assets of borrowers. We'll have a roundtable discussion with our amazing panelists and try to leave some room for audience Q&A at the end. Next slide. All right, so some brief introductions. We'll be hearing in a second from Adrian Smith, Senior Vice President of Research at OFN. Our panelists include Defina Williams, Executive Vice President for Public Policy at OFN, and we're very grateful to have Sarah Morgan, President of FAHI, join us. I'm David Greenberg, Vice President of Community Research and Impact at the Local Initiative Support Corporation. Next.
Okay. Well, thanks for the introductions, David. I'm Adrian Smith from OFN, and as David said, we're going to kick it off with two brief research presentations. So my presentation is on a paper that we're calling, that we've titled CDFI Fund Financial Assistance Awards and OFM Member Loan Funds. And so the presentation is about this research study that we're finishing up. It's going to be released later this month, and it's a quantitative study of the effect of CDFI fund financial assistance awards on OFM member loan funds. So this project, it really started with a request from OFN's policy team. They wanted an empirical examination of the effect of FA awards because there have been two existing studies to date on the topic, but those happened 10 or more years ago, so we really wanted to update the research. Next slide. So since it was created in '94, the CDFI Fund has made awards to community-focused financial institutions throughout the country, and CDFIs use the fund's grants and other funding mechanisms for diverse purposes. The paper examines the effect of one of the fund's signature initiatives, namely financial assistance awards from both the CDFI program and the Native American CDFI Assistance Program. We focus on a central research question. How does winning their first financial assistance award affect OFM member loan funds' financial strength, leverage, and lending? Next slide. So CDFIs use FA awards in various ways, diverse ways, from lending capital to loan loss reserves, to capital reserves, to operations, technical assistance provision. The fund has a competitive application and review process involving 5 steps from eligibility review through the award amount determination. And I mentioned the review process in part because it involves, from a research standpoint, it creates a selection effect. So we have to estimate, the empirical analysis must separate the factors that cause OFM members to apply for and receive an award from the effects of the award itself. Next slide. So I want to talk a little bit about our data sources and methodology. Our data set for this study spans 2009 to 2022. And we have 2 key data sources. To conduct the analysis, we merge data from on FA awards from the fund's awards database with IRS Form 990 data. Every year, nonprofit organizations are required to complete Form 990, which includes a lot of information on their finances. So we use information from the awards database to code our key predictor variable, which is receiving a first FA award. And then we use Form 990 data to measure the financial strength, leverage, and lending outcome variables. So I mentioned then in terms of methodology, I mentioned that selection effect before. We have to separate the factors that cause OFM members to apply for and receive an award from the effect of the award itself. So in order to do that, we take OFM member loan funds that received an award and match them with similar members that did not receive an award at baseline, like before they received that award. So that's the matching component. Secondly, we have a difference in differences approach. And that's an analytical method that allows us to understand the impact of programs that begin at different points in time for different organizations. So this is the case for FA because as many people know, it is awarded annually. So we use the difference in differences to compare each organization's trajectory to similar non-awarded organizations. Next slide. So our sample for the study is nonprofit OFM member loan funds that are not subsidiaries of larger organizations. So there's like a couple reasons for this sample. First, we have the best understanding of the sample, including their EINs, organizational EINs. And we needed EINs to match the FA awards data with 990 data. And in the Form 990 data, the financial metrics of subsidiary organizations are not separable from the larger organizations that they're a part of. So to tell you a little bit more about the sample, these are two figures. The figure on the left-hand side shows the number of organizations in the active sample, like what the sample is, all active OFM member loan funds in a given year, all certified loan funds, and all certified CDFIs for the analysis period. And the figure on the right-hand side shows the number of FA awards in each of those groups, awardees in each of those groups. So the key takeaways, I know it's a lot to digest, the key takeaways from these figures are one, that the number of active loan funds in the sample tracks closely against all active OFN member loan funds from 2009 to 2021. So that's true both in terms of their existence as organizations and as FA awardees. It's important to note that the sample is less representative of all certified loan funds and all certified CDFIs. So the upshot is that while the findings presented in the report can be generalized to OFN's membership, they shouldn't be extrapolated to all certified loan funds and all CDFIs as a whole. Next slide. So outcome measurement, we have three categories or domains of outcomes measures. We're interested in financial strength, leverage, and lending. So in terms of financial strength, CDFIs rely on their balance sheet strength to lend into communities, right? So healthy balance sheets create sort of a virtuous circle where financial strength leads to greater access to capital, which in turn leads to more lending. So we have four measures from Form 990 to get at financial strength: total assets, net assets, earned revenue, and contributed revenue. The second domain is leverage. So a secondary effect of strong balance sheets is the ability to attract new funders and investors. So we use two variables to measure leverage: notes payable and then capital available for lending. And finally, lending, right? Once CDFIs leverage and attract additional capital, we expect them to put it to use in terms of lending into their communities. And so all that results in larger overall sizes of members' lending portfolios. Next slide. So this is like a summary of the key findings from the paper, this infographic. So overall, we find that winning a first FA award provides OFM member loan funds with more capital and more flexibility. This support in turn creates stronger balance sheets, greater leverage to attract capital from different sources, and increased lending to achieve mission impact. That's like the key takeaway from the paper. In the near term, FA awards hit OFM member loan funds balance sheets, strengthening their finances. And in that medium to longer term, like 1 year plus, FA awards provide OFM member loan funds with leverage to raise more capital from different sources and increase the volume of their mission-focused lending. Next slide. So I just want to show you like two findings graphs on this slide. So to dig a little bit deeper into the findings, on the left, you can see how members leverage a first FA award to increase the volume of their notes payable. So between 1 and 3 years after awards, members that received a first FA award increased their notes payable by 1.2, 1.6, and $2.9 million relative to the comparison group that didn't receive a first FA award. On the right-hand side, we have total loans outstanding. And so members that received a first FA award put the award to work in their lending portfolios. So for an average member that got an FA award, a first FA award, the increase in mission-aligned lending is $2 million on average in year 1. And that goes up to an average of $6.2 million in year 3 relative to similar non-awardees, non-first-time awardees. Next slide. So just to summarize a little bit, in terms of implications of the research, first, we find that member loan funds use government funding via FA awards to generate capital from other sources. We see this as an important and timely outcome of the study. Second, OFM member loan funds put FA dollars to work in their lending portfolio, thereby enhancing community change. And third, program design members. In the paper, you'll see when you read it, we found different effects of FA awards based on relative award amounts and loan fund size. And when you see the paper, you'll see that how this program design element comes into play. So in terms of future research, researchers and CDFI stakeholders have called for improved data assets and more resources focused on data collection systems and infrastructure. There were some challenges in doing this research, and we just kind of echo that call and underscore how more can be learned by improving the CDFI data infrastructure. And finally, we think there's a lot more to be learned on FA awards. We just scratched the surface here, and we suggest examining things like why the factors that lead CDFIs to apply for FA awards in the first place, and also comparisons between different CDFI fund programs, such as BGP, New Markets Tax Credits, FA, and others. And so I'm going to hand it over to David, and next slide, and he'll do his presentation on his research. Thank you.
Thanks so much, Adrian, for that important presentation. I'm going to present some findings in a second, but just to contextualize, Adrian's research, OFN's research, is about the flow of public capital into CDFIs in ways that help strengthen them and deploy capital into communities. And this study that I'm about to present is about what happens after that. How does CDFI lending impact the wealth and assets of borrowers to loan funds? So I'm David Greenberg, and again, my title is Vice President for Community Research and Impact at the Local Initiative Support Corporation. Thanks so much to everyone in attendance. It's a really great crowd today. And again, to Adrian, Defina, Sarah, and OFN for bringing us together. So for those who don't know us, LISC is a CDFI and community development intermediary that works in urban and rural areas in every state and several US territories. And my team's role is to understand our impact and those of our partners in ways that can advance knowledge and drive resources to the field. Next slide, please. Again, this is a study about the impact of CDFIs on borrower wealth and assets. And so my primary acknowledgement is really to list borrowers and partners who drive such critical work in communities around the country. I also want to thank list colleagues in our policy lending treasury teams and among local offices, and to the Carsey School for its support of the research. But I also really want to acknowledge the lead authors of this report, Sieva Rodnyansky and Christopher Tan. While I helped shape this research, they really implemented it. And so this webinar gave me a very opportune moment to really reflect on what this research is meant to accomplish, especially for this practitioner audience. So CDFI practitioners and community practitioners really know that they have impact because they see it every day. So the frame I want to offer is not so much that this research validates the outcomes that you know you can accomplish, but instead to encourage discussion of the kinds of practice supports that are really needed to realize these good outcomes and the role of public policy in promoting them. And that's why I'm especially excited to get to the panelists in a little bit, who will be exploring these very questions. Next slide, please. All right. So with that in mind, I do want to offer that LISC views this report as timely evidence about the impact of CDFI lending on the wealth and assets of their borrowers. So why is this question? Surprisingly, despite practitioners all around the country who have helped small businesses and community organizations grow in strength, there's been very little data about the impact of CDFIs on an outcome that was in fact one of the major impetuses for their creation, that is the wealth of their borrowers. And so in my view, this is a really critical gap because one of our missions is to overcome the effects of financial exclusion and predatory inclusion. So we're all familiar with the ways that the Homeowners Loan Corporation's failure to ensure loans in neighborhoods based on race excluded Black Americans from homeownership. And this and centuries of wealth stripping have resulted in a Black-white wealth gap at the household level, which has hovered around 10 times for many years. There's also similar evidence about the effects of capital exclusion to small businesses and nonprofits. So just sharing one data point. Some research shows that Black-owned startups are approximately 3 times less likely than white-owned startups to report having a loan request approved, even when controlling for credit and net worth. So this research is really about how can CDFIs counteract these trends in under-resourced areas. And in doing so, we also want to call out the role of credit enhancements, which are a critical policy and philanthropic tool that, as you know, helps mitigate risk and drives down the expense of capital. And Defina and Sarah will speak to that soon. And finally, current volatilities within the community development ecosystem that are both driven by economic factors and have an obvious public policy dimension make it really even more important to understand how to strengthen the organizations that strengthen communities. Next slide, please. All right, so we asked 3 questions in the study. What's the overall impact of CDFI activities on borrower wealth and asset levels? How do these impacts play out for diverse leadership subgroups like BIPOC and women-led groups and first-time borrowers? And what role do credit enhancement have in letting CDFIs move beyond their normal credit boxes and in impacting wealth and asset growth? Next slide, please. So I believe that Megan and Mackenzie may have put a link to the report in the chat. So I would really refer you all to that for more detailed findings, but I want to give some highlights to kick off discussion. So essentially, we used anonymized data from borrower financial documents related to underwriting and loan closings and asset management for 631 loans that closed during the time frame of 2016 through 2020. About 40% were rental housing development, 5% supported home ownership, nearly 30% supported commercial or community real estate, and 14% were for economic development and small business. And we used that information to estimate CAGRs of assets, liabilities, revenue, expenses, and associated ratios. So one important caveat that I want to mention is that we recognize that viable organizations tend to grow over time. And in fact, our lending, CDFI lending, is really meant to help grow wealth and assets. So we needed a comparison group to suggest what the impact of lending was over and above what might have happened otherwise to an organization that didn't receive a loan. So to do that, we use the Urban Institute's database of nonprofit CBDOs that drew from 990 records, just like Adrian's research did. So in addition to our including more varied kinds of organizations in our data, like small businesses, for example, um, it's important to note that the average list borrower is much larger than the average CBDO, with assets that are about 9 times larger and revenues that are about 3.5 times larger than the average for a CBDO, which really reflects the fact that many CBDOs don't own or manage real estate. So this is a data and a research consideration, but in my view, it also raises some important practice questions about how to support groups when appropriate to be able to do projects and access capital that can also support their financial strength. Next slide, please. All right, so what do we find? Again, would refer you to the report for more details, but just to kick off our panel conversation, I'll highlight a few things. First, CDFI lending appears to positively impact borrower wealth and assets. So sampled borrowers have higher annual growth rates in assets and revenue and lower growth rates in liabilities and expenses compared to CBDOs as a whole. So just one example, total assets grew by 6.1% annually compared to 2.4% for the universe of nonprofit comparison groups. Also significantly, these impacts were robust and held up across diverse subgroups. Financials really improved for almost all subgroups, including nonprofits, BIPOC and women-led groups, and first-time borrowers. And so for all of these entities, for example, revenue growth exceeded that of the comparison group of all CBDOs. Next slide, please. All right, so second, as intended, and everyone on the call, I'm sure, experiences this in some way, credit enhancements really expanded the reach of CDFI lending. So about a third of the 631 loans received some form of credit enhancement through programs like the Capital Magnet Fund or program-related investments, which allowed LISC to achieve higher loan-to-value transactions. It lowered interest rates. It permitted work with smaller developers, it covered losses, and in some cases supported cash businesses seen as riskier due to an absence of documentation. Also, just significantly for this policy discussion, borrowers receiving credit enhancements also appeared to have grown wealth and assets, though in transparency, they did that sometimes less than their non-enhanced counterparts, which may reflect the fact that their financials may have been more challenged to begin with. So for example, they saw a growth in total assets of about 5% rather than 6.1%. Can we go to the next slide? Thanks. So there's also a qualitative component to the study where borrower interviewees reflected on the but-for of receiving a loan. And they spoke not just to the importance of the capital for projects and for the business or the nonprofit, but also of the importance of a relational lending approach and the technical assistance which CDFIs can provide. So some quotes. We would have struggled to build our facility. I probably would not have my small business. How do they take the total person? That's the impact of the CDFI. How do they know enough about you for where you're trying to go? Their care and concern about overall well-being, not just a loan. Through a LISC program, we hired a business coach for long-term coaching one-on-one, and that person helped us do process mapping. We grew 600% over 3 years. And how do we get more lenders comfortable with this? Next slide, please. All right, so what do these findings suggest? First, Absolutely, the need to support CDFIs through federal policy and increased investments. So, as a field, CDFIs have grown significantly over the last 20 years, which wouldn't have been possible without the CDFI fund. And so, LISC supports increased appropriations for the fund to meet the growth and needs of the sector, and also related legislation to support CDFIs, including tax credits, and also support of the Economic Mobility Corps, which places AmeriCorps service members at CDFIs. Second, the need to support specific CDFI programs that provide credit enhancements. So in this study, borrowers receiving credit enhancements also saw wealth and asset growth, despite the deals and entities being potentially riskier. So there are several CDFI fund programs, including the FA program, which Adrian just talked about, the CDFI bond guarantee program, and the Capital Magnet Fund, which make cheaper capital available and help CDFIs grow their lending capacity. Third, we really need to be supporting the whole community development field through federal capacity building and technical assistance programs. So as I mentioned, list borrowers tended to be larger than CBDOs as a whole, which really suggests a need to braid lending and technical assistance effectively in order to help support and grow the field to access capital when it's appropriate, especially among nascent and smaller organizations, and in areas that have been previously excluded from resources like Appalachia, as we'll hear from in a bit. Finally, private funders also have a real role in providing flexible grant capital to CBDOs, supporting TA and capacity building programs, and providing credit enhancements to CDFIs in ways that can expand their impact. So again, on behalf of LISC and my colleagues again, Sieva Rodnansky and Christopher Tan, thanks for this opportunity to present, and looking forward to the panel discussion in a second.
Next slide, please. And I'll invite David back on, and Sarah and Defina to start our roundtable discussion. Hi again. Welcome to the webinar, Defina and Sarah. So we wanted to open it up to a roundtable discussion. I'd like to start by asking Defina, together the papers are, as David mentioned, about the cascade of funding and capital from the CDFI fund to CDFIs, and then David's from CDFIs to borrowers in ways that enhance wealth and stability and really the vitality of organizations. So we'll get to Fahi's experiences in a moment, but Defina, first, can you speak to the importance of these research studies to your policy work? Like, why did you ask our research team to conduct a study on the effects of FA awards? And how can a paper like LISC really assist and enhance your work?
Yeah, absolutely. And thank you so much for having me, Adrian. And I apologize if you hear background noise. There's construction in my building, but I'll try to just talk louder. So I think these papers are being released at a perfect time when there are real questions in the policy environment about the CDFI fund and its impact, and about CDFIs and our impact collectively. So anytime we're in kind of a tight funding environment, that means there's going to be extra scrutiny around how each federal dollar is spent. And the best advocacy brings a combination of the anecdotal borrower stories about the real people we help on the ground, but also demonstrating how these particular funds are actually having an impact on the sector and in our community. So part of the goal of our policy work is always to bring more people into the tent and to expand support for the programs. And there's, always been policymakers who may have had questions about the program's impact, of course, on the ground, but also want to understand, like, just more deeply how the federal spending itself is having an impact. So being able to draw that connection from the appropriated dollar that comes from Congress, that goes to the fund, that goes to the CDFI, to the community or the project, is really something that's powerful. And as you mentioned, Adrian, we haven't really had the data updated to be able to sort of make that connection since 2012, 2013. I think one of the things that's also really interesting about the FA program is that it's not project level funding. There are lots of federal and state programs where you can get an allocation or grant or loan. It goes directly into a project, and you can kind of immediately track that dollar to the result of the project. But CDFI FA awards are like at the institution level. It's not always immediately obvious, where the what's being funded or how the capital is deployed, because the CDFI fund essentially is investing in the organization's business plan and your strategy and letting the organization make those investment decisions on the ground. And that's a really powerful talking point for our audience. For a lot of audiences, it's very compelling. But we also want to be able to like back that up and demonstrate how these limited federal resources are actually being used. And again, I think that's really important in this current policy environment where there's been a little bit more skepticism about the model and the work of CDFIs, and the industry is sort of needing to defend the program and its impact around some of these exact issues that the paper addresses, right? We're getting questions around how CDFIs are attracting and bringing in private sector leverage and how CDFI fund dollars support that. We're getting questions about job creation and the impact on the ground. And so I think that this paper is going to be a lot of really useful information, not just for us as we're doing our policy work and making the case, but also for our allies and our champions on the Hill and in Treasury who are actually looking for evidence to demonstrate the effectiveness of these public sector investments. These types of studies help policymakers make the case for CDFIs themselves, right? If they can use these studies in hearings, or they can be entered as part of the congressional record. And so it's really helping to complement the industry's kind of long history of storytelling with some of that empirical data that really just brings to light all of the work that we're doing on the ground.
Dafina, thanks so much for that policy context for the research. Sarah, I'm wondering if you can sort of like drill down to place and to practice. Could you tell us a little bit about FAHI and its members, and how do you think about the importance, as I think the two papers showed, about the need for strong organizations in Appalachia, and what's the role of loan capital in enhancing their strength?
Thanks, David. Thanks, Adrian and David, for having me here. I appreciate the offer. So FAHI is a membership organization, not unlike OFN, and our members are based across Central Appalachia. These are communities where extraction has been the norm and investments haven't been made back in. And so the importance of the CDFI fund is it has enabled that institutional level investment. FAHI was one of the first CDFIs in the first round of certifications. We've probably received only about $12 million in FA awards, and yet our lending has been over the $2 billion mark. So it enables the growth of our balance sheet. It enables, and that lets us draw more resources onto balance sheets, and it lets us do more. Loan capital, it's the gas that moves our community forward, and we need it in the engine. I hope that answered what you were looking for.
Thanks. So I'm going to go back to you, Sarah. Our paper, and you started talking about this, the paper talks about how FA awards influences member loan funds' balance sheet strength, their ability to leverage their lending. Can you provide some examples in the other areas of how FA, how FAHI has used FA dollars to raise more capital from other sources and to really increase your lending portfolio?
Yeah, I think there's one specific example that I can give is, in Kentucky, there's a community called Williamsburg. It's right on the border between Kentucky and Tennessee. If you live in that community, you had to drive an hour and a half away if you needed an OBGYN appointment, or you needed an MRI, or you needed any sort of specialized medical services. We were approached because we are a recipient of USDA community facilities relending money to try to drive those funds, particularly in the places of persistent poverty in our country. We ended up engaging in a transaction we call Dayspring that converted a big box store, into a medical campus. We ended up providing the construction loan. And then we did this in conjunction with Hope Credit Union out of Jackson, Mississippi, and in partnership, and we then provided the permanent loan via the USDA Community Facilities Relending money. We drew those USDA funds onto our balance sheet, but for every dollar we drew, we needed 20 cents of equity in order to maintain a healthy balance sheet. And we would not have been able to do that had we not had FA awards. That facility is operating today. It immediately employed 88 people and is providing health care to over 20,000 people in the community.
Thank you. And Dafina, just to pass it over to you, I don't know if you want to speak to how you think, or that other members use FA to enable specific community development projects on the ground, either broadly or examples that you know of.
Sure. Well, I think just a couple of things to note here. I want to talk a little bit about how the FA program actually helps OFN to deploy more capital to our network. So I think, if you're in this space, you know that the financial assistance awards are consistently oversubscribed, meaning that people apply for significantly more resources than there are available on a yearly basis. And OFN has been a recipient of financial assistance awards a couple of times over the years. And what we do is we're able to bring that capital into our balance sheet. And like all other CDFIs, we use it to attract additional private sector capital. But that then enables us to be able to deploy more resources to CDFIs in our network who maybe were not able to actually access the FA awards on their own. So maybe you applied and didn't get it, or maybe your organization's not quite ready to apply for the award themselves. And so an intermediary lender like Fahi and like OFN can actually take on that capital, use it to bring more resources in, and actually expand the reach of the FA dollars even further than they would go if some of these organizations were able to apply directly. So I think that's one thing that as a trade association, as a lender ourselves, we've really been able to leverage these resources to have a greater impact. The other thing that I think is interesting about this program is that it's actually become a model for some state level programs. So there are now like state level CDFI fund programs that are being created in California and in Michigan, and they're taking a lot of their kind of structure and parameters from the federal FA program because it's actually really effective and it actually works quite well. And so we're beginning to see that, it's not just that we figured out something that works well, which is providing that flexible institutional capital at the federal level, but that it can actually be a model for increasing capital and bringing more resources in at the state and local level as well.
Thank you. David, I'll pass it over to you to ask the next question.
So this is back to Sarah. So one of the things that we really explore both in practice and in research is like how can CDFIs really support their borrowers throughout the process to help build them up. One of our sort of like the data facts of our research was that we are working with larger entities than the typical nonprofit. But really what that's about is like, how do you get people to the place where they're able to effectively deploy loan capital? So I'm wondering if you can just like share some success stories about your work with your members. Like, how do you support them? How do you think about partnerships that you feel are successful? And, what do you think it takes to make the kind of growth of local developers successful?
Thanks, David. So we have a member based in Hazard, Kentucky, the Housing Development Alliance. They were born out of the launch of the Home Investment Housing Partnership Program in the early 90s. They've been developing affordable housing in a really hard to serve region for, now many, many years, almost 30. And they were finding that clients of theirs who wanted to buy a home were having trouble qualifying because of existing debt that was stacked that they had. And so they ended up exploring the creation of a CDFI that would provide consumer debt. And they launched Redbud Financial Alternatives. James Cottle, who is the leader there is on today, I think, with us. And they provided access to credit directly to people to basically restructure their own personal balance sheets. One of the first success stories was a gentleman who used to be a coal miner who was able to, in his retirement, restructure his debt and buy a home. And so it's an example. Now, what happened there was they needed lending capital to launch Redbud, and they didn't have a track record. And so a traditional lender was like, this is no good deal. They don't have an experience. They don't have a balance sheet. We were already managing and servicing HDA's mortgage loans. So it was a no-brainer to us to provide a $300,000 enterprise level loan to Redbud to allow them to do some loans, demonstrate proof of concept. And then when they were successful, some of the investors who invest in Fahi, we made introductions to James and his team, and they were able to secure some low-cost capital through folks like the Adrian Dominican Sisters and several of other particularly religious investors.
Thank you. That's a really powerful example, I think, and you know, as we're talking about that cascade of capital, you know, its public policy dimension, what it leverages, you know, how it goes to CDFIs. What you just shared is how it actually reaches, you know, consumers and individual households in regions that have experienced so much extraction. So really appreciate that.
Thanks.
So, you know, as researchers, David and I like research questions. And in the current federal policy environment, Sarah and Defina, what are FAHI and OFN's members experiencing that you think researchers and practitioners that are on this webinar should pay attention to?
I'm happy to chime in first. I think, you know, I think this is a really important step for the industry in being able to actually explain how valuable the financial assistance awards and CDFI lending is. But I do think there are other questions that have been emerging as we've been navigating, you know, sort of a more challenging policy environment. I just want to say that, you know, although it feels like a lot's been coming at us this year, the questions about whether or not these programs worked and have impact predate the second Trump administration, right? They've been getting these questions from going on Hill meetings and interacting with for, you know, over a decade. And so I think it's natural for, you know, people who are providing resources to want to understand that if they're actually having the impact that we say they're having. So I'm excited that we're able to really be able to draw that connection point more clearly. I think one thing that comes up a lot now is not just around like, okay, are you attracting private sector leverage, but are you actually having the impact you say you're having on job creation and on actually moving the needle on some of the things that David was talking about? Like, are people's lives actually being measurably improved by the investments that CDFIs are making? And we do such a good job of telling the story anecdotally as CDFIs, and we need to keep that, you know, as it's critical to being able to move the needle on policy. But I've noticed a very, you know, marked increase in the sophistication of Hill staffers and of other kind of policy staff that are working in agencies, and they want more data, they want more numbers, they want to understand a little bit more about what's actually happening beneath the nice stories that we tell. And so I think as an industry, as we are getting more and more investment and more resources from the public sector, it is on us a little bit to make sure that we're bringing that actual like evidence and empirical evidence to continue to make our case. So I think that more studies like this are incredibly important because we want to make sure that we're able to say, you know what, we are actually having the exact impact that our storytelling is saying. It's just a nice complement to you know, the way that we've been doing advocacy before.
I agree wholeheartedly with Defina on that, and I would just add that our states have a real interest in how their economies work, of course, and so being able to talk to our state officials, both at the economic development cabinets, the departments for local government, whatever they happen to be in the states, about how money works to really reach deeper into the marketplace is going to be really important. And this provides evidence and research that can help support those conversations. I also think, if I could just add real quick, anything we can do to turn the conversation from project by project financing to how we are building systems that work for people is really important. And that is the single biggest fabulous thing about the CDFI fund, is it really is about changing systems.
Sarah, Dafina, David, any additional or final thoughts before we open it up to our audience for questions?
Well, this is a little bit of a plug and a preview, I guess, if OFN doesn't mind, for their upcoming conference, but really excited that the pre-conference research symposium will be presenting a lot of good evidence about the impacts of CDFIs at the community level, as you're saying, Dafina, and that obviously relates, Sarah, to this question of systemic change. How do local ecosystems get built up through the infusion of capital and the other kinds of work that CDFIs and their partners do. So more to come on that, but really value that's where the field is going.
And I just wanted to give a shout out to Adrienne and her team, because this is an amazing piece of research, but it's also very complementary to another paper that was put out earlier this year, which is on the business model of loan funds. And in our advocacy work, we find that people tend to have an understanding of what a bank does and how it works, and what a credit union does and how it works, but there's a lot of mystery around the loan fund model in particular. And so I find these two research papers to be very complementary to each other. So the business model of loan fund, the business case, it's really explaining, like, what is a loan fund, how does it work, what are the different sources of capital, and and this really drives home the sort of public sector piece of that. And so just being able to have those wonderfully produced studies to be able to support our advocacy work with actual evidence and is really powerful. So I just wanted to shout out that this is not in a vacuum. This is actually really part of the work we've been doing together to really help demystify the loan fund model on Capitol Hill and beyond.
Well, thank you both for those plugs for our work. We're excited for the second annual research symposium hosted in partnership with the University of New Hampshire Center for Impact Finance. And yeah, we're excited about LIF's research portfolio and our own growing research portfolio as well. So I will open it up to the audience questions. We have a good one. So building on Dafina's point about more and better data, is anyone looking at more granular data that measures social return on investments as part of the impact discussion? So one thing, and David, feel free to jump in, but one thing that I'm aware of that just came quickly to mind is some of our members, one in particular, Carolina Small Business Development Fund, researchers there have been really interested in social capital and how CDFI lending and small business lending really promotes and enhances social capital, social connections between the community, between the CDFI and its community, increases bonds within communities. So I'd encourage folks to check out that as one element of social return on investment. David, any other research you're aware of on the social return on investments?
Yeah, I think it's a great point. It's not just dollars out the door. It's what is the broader impact. There are different ways of thinking about those social returns. I've always been interested because CDFIs work in community spaces and places for research that talks about the impact not just of CDFI alone, but of the whole partnership network in driving forward outcomes at the place-based level. LISC has some research that I'm proud of that explores that in California, the Coachella and San Joaquin Valleys, and in South Minneapolis. There are a couple of upcoming papers at the research symposium that get at this question in Kensington and modular manufactured home facilities, but this is, I think, a great direction that people are starting to explore more.
I can add an anecdotal piece of information. You know, we've been working in response to the flood recovery in Eastern Kentucky from the flooding in 2022, 23, and more recently, I think again in 24. It seems to be coming on and on and on. One of our really small communities, the judge executive was really concerned about the loss of tax base because of the houses that had been washed away. And one of the things that they found is the rebuilding of quality homes in the community where hundreds had been washed away, rebuilding just a handful replenished that tax base because they were so much higher quality. And so those are we have to talk about the impacts to our communities, what that does to our school systems, which are largely funded out of the tax base. It's a cycle.
And Sarah, there's a question about the Rosebud example. So was Rosebud CDFI when it received its initial funding? And can you just clarify whether it got an FA award, if you know of it, or whether some of its initial funding and investment came from FAHI or OFN or a different source?
Yeah, so no, it was not a CDFI. It was just a loan fund, and it had to demonstrate and make loans before it could apply to be a CDFI because it had to have a demonstrated track record. So we made the loan when it was a loan fund with a good set of policies and very limited track record from their initial investment from the Housing Development Alliance. They have gone on and they have grown tremendously. They have received 4 FA awards, as I understand it, and have one day, James, my friend, called me because he achieved like $750,000 worth of private loan capital in a week. And I was like, really good for emerging CDFI.
Great. And we have another question about consumer lending. So the attendee is a small dollar consumer loan fund in Connecticut, New England. And so they make small unsecured loans of about $400 to $1,000 to individuals to give them alternatives to predatory lending for people who have low or no credit scores but are working 1 or more jobs. So do we have any data on consumer lending in the nonprofit model versus predatory payday loans, BNPL loans, et cetera? David, I don't know.
I don't have any data. What I can say is that we have a friend in the industry who has created the community loan center model based out of Brownsville, Texas, where it's an employer-based model. And so employers sign up, it's a benefit employees can access, and it's an alternative to payday loans, and they've got a bunch of data. There we go. Thank you, Clarissa.
Yeah. Clarissa in the chat mentions that the Urban Institute just released a report on the impact of the CLC franchises, which is great. Any other questions from folks either on the panel or in the audience? Great. Well, David and I certainly are open to receiving your emails or other inquiries about the research. The link to the list paper, which is currently available, will be reposted in the chat. The OFN paper will be available later this month, very shortly. We're just going through some final formatting. And we do have research events such as the Research Consortium, Research Symposium coming up, lots of panels on research and policy, of course, at the OFN conference in just a week and a half's time. And yeah, we look forward to future collaborations on these research projects and other research projects, and future ways to let dialogue across practitioners, policy advocates, and researchers. Anything to add, David, or co-panelists?
No, thanks so much.
For having
Thanks.
me.
Thanks for the invitation.
Thank you.